For years, betting on big tech through QQQ felt like one of the easiest ways to win. AI was exploding, cloud computing was growing, semiconductors were everywhere, digital platforms kept getting stronger, and many investors looked at QQQ and thought, why not just bet big on tech? But in 2026, the question is more complicated. QQQ is still powerful, but it is also concentrated. It is still connected to some of the most important companies in the market, but investors may already own many of those companies inside other funds. So the real question is not just, is QQQ a good ETF? The better question is it still smart to bet big on tech at today's expectations? That is what this video is going to break down. Technology has been one of the biggest wealth creators in the modern stock market. Big tech, software, cloud, AI, chips, digital platforms. These themes have helped drive huge investor returns. And QQQ became one of the easiest ways to get exposure to that growth. But strong past returns create a new problem. Expectations rise, valuations rise, more investors crowd into the same trade, and the margin for disappointment becomes smaller. That does not mean QQQ is bad. It means QQQ needs to be analyzed carefully, because the same forces that made it powerful can also make it risky. So before deciding whether QQQ still makes sense in 2026, we need to understand what QQQ actually is. QQQ is an ETF that tracks the NASDAQ 100 index. In simple terms, it gives investors exposure to large, non-financial companies listed on the NASDAQ. That includes many businesses connected to technology, growth, software, semiconductors, cloud, digital advertising, consumer platforms, and AI. But QQQ is not the whole stock market. It is not the same as an S&P 500 ETF, and it is not the same as a total U.S. market ETF. It is a focused ETF. For beginners, the important point is this: QQQ is a basket of companies, not one stock. But for more advanced investors, the important point is this: the basket is not evenly balanced. The biggest companies can drive a lot of the results, and that is where the real analysis begins. QQQ may look diversified because it owns many holdings, but number of holdings is not the same as equal risk. If the biggest companies have the largest weights, they can dominate performance. That means QQQ can own around 100 names and still be heavily influenced by a smaller group of mega-cap companies. This is not automatically bad. In fact, that concentration helped QQQ when those mega-cap growth companies were winning. But investors need to understand what they own. If the biggest names keep growing, QQQ can benefit. If those same companies disappoint, QQQ can feel the pressure. So the issue is not whether QQQ owns many companies. The issue is how much influence the largest companies have. And that influence is one reason QQQ became so popular. QQQ became popular because the story was easy to understand. Buy the future. Buy big tech, buy growth, buy innovation. Investors wanted exposure to AI, cloud computing, software, semiconductors, automation, and digital platforms. And instead of trying to pick one winner, QQQ offered a simple way to own a basket of major growth companies. That is a very attractive idea. It is easier than trying to guess which single tech stock will win. It is simpler than researching dozens of companies, and it gives investors exposure to some of the strongest business models in the modern economy. But popularity is not the same as safety, and a strong story does not remove risk. That is why the next point matters. QQQ is powerful, but that power is not free. The same things that helped QQQ can also hurt QQQ. Growth leadership helped. Mega-cap winners helped. The AI narrative helped. The digital economy helped. But if valuations get too high, that can hurt. If expectations get too aggressive, that can hurt. If market leadership rotates away from growth, that can hurt. If interest rates pressure long-duration growth stocks, that can hurt. This is why QQQ should not be treated like a magic ETF. It is a focused growth tool, and focused tools can work very well when the environment supports them, but they can also disappoint when the market changes. To understand that clearly, we need to compare QQQ with broader ETFs like VOO and VTI. QQQ is not VOO, and QQQ is not VTI. VOO gives investors exposure to the S&P 500. VTI gives investors exposure to the total U.S. stock market. Those are broad market tools. QQQ is different. QQQ gives investors focused exposure to the NASDAQ 100. It is more growth-heavy, it is more tech-influenced, and it can be more concentrated. That does not make QQQ worse. It just means QQQ has a different job. VOO and VTI are often used as portfolio cores. QQQ is often better understood as a growth tilt. And that brings us to one of the most important questions in the video. Should QQQ be your core, or should it be a satellite? A core holding is the foundation of the portfolio. It usually gives broad exposure, lower concentration, and a structure the investor can hold for a long time. A tilt is different. A tilt is an intentional extra bet. It can be used to increase exposure to a theme, sector, style, or opportunity. QQQ can be powerful as a tilt. It can add growth exposure. It can increase tech exposure. It can give investors more connection to AI, cloud, software, and semiconductors. But as the entire portfolio, QQQ becomes much more aggressive, more concentrated, more dependent on growth stocks, and more exposed to valuation risk. So for many investors, the better question is not, should I own QQQ? The better question is, how much QQQ makes sense? Before answering that, we need to understand what QQQ does well. The biggest strength of QQQ is exposure to market leaders. It gives investors access to companies connected to some of the most important economic themes in the world: AI, cloud computing, semiconductors, software, automation, digital platforms. These are not small themes. They influence how businesses operate, how consumers spend, how data is processed, and how productivity may improve. For investors who believe these trends will continue, QQQ can be attractive. Instead of betting everything on one company, QQQ spreads exposure across a group of major growth names. That can reduce single stock risk, but it does not remove theme risk. You are still leaning into growth, technology, and market leadership. So QQQ can be simpler than choosing one tech stock, but it is not risk-free. For many investors, QQQ is easier than trying to pick a single tech stock. A single company can miss earnings, lose market share, fail to execute, overpay for growth, or get disrupted. QQQ reduces that company-specific risk by holding a basket of businesses. That is a real advantage, but it is important to not confuse reduced single stock risk with full diversification. QQQ can still be exposed to the same broad forces: growth sentiment, AI expectations, valuation pressure, tech concentration, and interest rates. So QQQ spreads company risk, but it does not remove the theme risk. That is especially important in 2026 because one theme is driving a lot of attention: AI. AI may be one of the most important investment themes of this decade. It can support cloud demand. It can increase chip demand. It can help software companies monetize new products. It can improve productivity. And it can create entirely new business opportunities. So the AI opportunity is real. But here is the critical point. A real theme can still be overpriced. Investors often make the mistake of thinking that if a trend is real, any price is justified. That is not how investing works. If expectations are too high, even great companies can disappoint. If valuations already assume massive future growth, the margin of safety can be small. So QQQ has AI exposure, but investors still need to ask what they are paying for that exposure. Expectations matter. A company can grow revenue and still disappoint investors if the market expected even more. A business can be excellent and still deliver weak returns if the starting valuation is too high. A theme can be real and still become a crowded trade. That is the risk with AI and QQQ. The question is not only whether AI grows, the question is what investors already paid for that growth. This is why valuation matters, earnings matter, interest rates matter, and sentiment matters. QQQ may continue to benefit from AI and growth, but investors should not buy it as if the future is guaranteed. The risk is not just owning tech. The bigger risk is not knowing how much tech you already own. And that takes us to concentration. The biggest risk in QQQ is concentration. Not because technology is bad, not because growth investing is bad, but because concentration can quietly become larger than investors realize. QQQ is influenced by mega-cap companies. It has a growth bias. It is heavily tied to technology and adjacent themes. It can be sensitive to valuation, and it can be volatile when market leadership changes. This matters because many investors already own the same types of companies in other funds. They may own VOO. They may own VTI. They may own a target date fund. They may own a 401k growth fund. Then they add QQQ and accidentally increase the same exposure. So the risk is not owning tech. The risk is not knowing how much tech you own. A fund can own many stocks and still be concentrated. That is one of the most important lessons for ETF investors. QQQ may own many companies, but the largest positions can still drive a major part of performance. This is why investors should look beyond the number of holdings. They should look at weighting. They should look at sector exposure. They should look at overlap. And they should look at how the fund actually behaves when growth stocks sell off. A fund with many holdings is not automatically balanced. And before adding QQQ, investors should check whether they already own QQQ-like exposure somewhere else. Many investors already own big tech without realizing how much. If you own VOO, you already own major technology and growth companies. If you own VTI, you own them too. If you own an S&P 500 fund in your 401k, you likely already have exposure. If you own a target date fund, there may be exposure inside the stock allocation. And if you own a growth fund, you may already be even more exposed. So before buying QQQ, ask one simple question. How much QQQ-like exposure do I already own? This is not about avoiding tech. It is about understanding the full portfolio, because adding QQQ may be a smart growth tilt, or it may be accidental concentration. The difference is intention. Adding QQQ on top of VOO can increase tech exposure. That can be perfectly fine if it is intentional, but investors should not mistake it for full diversification. VOO already includes many large growth and technology companies. When you add QQQ, you may be adding more weight to some of the same market leaders. That creates a growth tilt. It may improve returns if tech continues to lead, but it can also increase downside if tech sells off. So QQQ plus VOO is not automatically wrong, but it should be deliberate. The same is true for QQQ plus VTI. The key question is not, are these good ETFs? The key question is, do they create the portfolio exposure you actually want? And once you decide that, cost becomes the next issue. QQQ is famous. It is highly recognized. It is widely traded. And it has deep liquidity, which can matter for traders. But long-term investors should also know about QQQM. QQQM is also an Invesco NASDAQ 100 ETF, but it has a lower expense ratio. QQQ has an expense ratio of 0.18%. QQQM has an expense ratio of 0.15%. That difference may sound small, but for long-term buy and hold investors, fees are part of the decision. For traders, liquidity may matter more. For long-term holders, lower cost may matter more. So QQQ may be the famous ticker, but famous is not always the most efficient choice. When choosing an ETF, do not choose only because the ticker is famous. Look at the expense ratio. Look at liquidity. Look at the bid-ask spread. Look at how long you plan to hold, and look at whether the fund gives the exposure you actually want. QQQ is extremely popular for a reason, but investors now have more NASDAQ 100 ETF choices than they did years ago. That means the decision can be more precise. A trader may prefer one product, a long-term investor may prefer another. A retirement investor may care more about cost and holding period. So the right choice depends on the job. And once we understand the product, we need to talk about performance, because past performance is the reason many investors love QQQ, but it is also one of the biggest traps. QQQ has had impressive periods of performance. That is one reason so many investors pay attention to it. But past performance does not guarantee future returns. This is one of the most repeated investing disclaimers, but it matters here. The question is not whether QQQ was smart in the past. The question is whether QQQ is still smart at today's expectations. That depends on valuation, earnings growth, interest rates, AI monetization, market leadership, and investor sentiment. If growth remains strong and valuations stay supported, QQQ can continue to perform well. But if expectations are too high, even good results may not be enough. This is why buying winners after big games requires discipline. Winners can get expensive. That does not mean they stop being great companies. It means the price can start assuming too much. When everyone loves the same theme, the trade can become crowded. When investors expect perfection, even a small disappointment can hurt. When valuation rises too far, future returns may become more fragile. This is the danger of buying QQQ only because it has performed well. You may be buying great companies, but you may also be buying high expectations. A great ETF can still disappoint if the price already expects perfection. So investors should not only ask, what does QQQ own? They should ask, what expectations are already priced in? That matters because QQQ can fall hard. QQQ can fall hard. This is not a conservative bond fund. This is not a low volatility income strategy. QQQ is a growth-heavy ETF tied to companies that can be sensitive to interest rates, valuation, earnings expectations, and market sentiment. If growth stocks sell off, QQQ can suffer. If AI expectations disappoint, QQQ can suffer. If megacap leadership weakens, QQQ can lag. That does not mean QQQ is bad. It means investors need to know what they are holding. If you only like QQQ and it goes up, you may not actually be ready to own it, because famous companies can still create painful drawdowns. Famous does not mean safe. A company can be dominant and still fall. A brand can be powerful and still become overvalued. A business can grow and still disappoint. This is one of the hardest lessons in investing. Great companies are not always great investments at every price, and QQQ owns companies that many investors recognize. That recognition can create confidence, but confidence can become dangerous if it replaces analysis. Brand quality does not remove market risk. High expectations do not protect against volatility, and strong companies can still experience multiple compression. So QQQ deserves respect, but it also deserves risk management, and that is exactly the kind of analysis this channel is built around. This is the kind of no-hype ETF breakdown we focus on at Boring Money Wins. Not pretending QQQ is bad because it is popular. Not pretending QQQ is guaranteed to win because tech has been strong. And not buying AI exposure without thinking about valuation, concentration, overlap, and risk. If this kind of ETF analysis is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want clarity instead of noise. Now that we understand the opportunity and the risk, let's make this practical. Who may actually want QQQ, and who should be careful? QQQ may fit investors who want growth exposure. It may fit investors who believe in long-term technology leadership. It may fit investors who want exposure to AI, cloud computing, semiconductors, software, and digital platforms. It may fit investors with a long time horizon, and it may fit investors who understand volatility and can hold through difficult periods. But there's one important condition. QQQ works better when the investor already has a strong portfolio foundation. If QQQ is added on top of a broad core, it can become a controlled growth tilt. If QQQ becomes the whole portfolio without understanding the risk, it becomes much more aggressive. So QQQ may be useful, but it needs the right role. For many investors, QQQ may make more sense as a satellite position. The core of the portfolio can be something broader, maybe VOO, maybe VTI, maybe a diversified retirement account, maybe a mix of stocks, bonds, and international exposure. Then QQQ can be added as a growth tilt. That gives the portfolio more exposure to NASDAQ 100 leadership without making the entire portfolio depend on one theme. This approach can help control concentration. It can make the allocation easier to hold, and it can reduce the emotional pressure when tech goes through a rough period. QQQ can add growth, but the core still needs to survive. That is especially important for investors who may not be a good fit for QQQ. Some investors should be careful with QQQ. If you already own a lot of tech, adding QQQ may make your portfolio more concentrated than you realize. If you are close to retirement, QQQ may create more volatility than you want. If you cannot handle sharp drawdowns, QQQ may be harder to hold than it looks. If you are buying only because AI is hot, that is not a strategy. If you are ignoring valuation, that is a risk. And if you do not already have a broad core, QQQ may make the portfolio too dependent on growth and technology. QQQ may be a great ETF, but it is not a free pass to ignore risk. So the next question is whether QQQ should be a core holding or a satellite position. QQQ as a core is aggressive. It creates more concentration. It creates more dependence on growth leadership, and it may create higher volatility. That may work for some investors, but it is not the default choice for everyone. QQQ as a satellite is different. It can add growth exposure while keeping the broader portfolio more balanced. It can give investors more technology and AI exposure without making the entire portfolio rely on one theme. For many people, that is the better structure, not because QQQ is weak, but because QQQ is strong enough that too much of it can change the entire risk profile. So the real question is not just, should you own QQQ? The real question is, how much QQQ can your portfolio survive? There are several practical ways to think about QQQ. One investor may use a broad core with a small QQQ tilt. Another may combine VOO or VTI with QQQ and bonds. A more aggressive investor may use QQQ as part of a growth-focused portfolio but still control the allocation. And someone near retirement may want lower QQQ exposure because volatility matters more. The key point is allocation. Your opinion about QQQ matters less than how much QQQ you own. A small allocation can be a growth tilt. A large allocation can become a major portfolio bet. So do not just ask whether QQQ is good. Ask whether the size of your QQQ position matches your risk tolerance, time horizon, and financial goals. And before choosing QQQ, investors should also know the alternatives. QQQ is not the only option. QQQM gives similar NASDAQ 100 exposure with a lower expense ratio, which may appeal more to buy and hold investors. QQQ may appeal more to traders because of recognition, liquidity, and active trading activity. VGT is different. It is a technology sector ETF, not the same thing as the NASDAQ 100. That means the exposure is not identical. This matters because investors often treat tech-related ETFs as if they are interchangeable. They are not. QQQ, QQQM, and VGT can all be useful, but they have different structures and different roles. Do not choose the famous ticker before understanding the exposure. Now we can bring everything together into the final verdict. So, is QQQ still smart in 2026? The balanced answer is yes. QQQ can still make sense, but not as a blind all-in bet on technology. QQQ still offers exposure to powerful growth themes. AI, cloud, software, semiconductors, and digital platforms may continue to matter for years. But QQQ also comes with concentration, valuation sensitivity, volatility, and overlap risk. For many investors, QQQ may be better as a controlled growth tilt than as the entire portfolio. If you already own VOO, VTI, or a 401k index fund, check your overlap first. If you are buying QQQ only because tech has already gone up, be careful. QQQ can be strong, but strong does not mean risk-free. The right question is not simply, is QQQ good? QQQ is a strong ETF. The better question is how much QQQ fits your portfolio. How much tech do you already own? How much volatility can you handle? How much overlap are you adding? How long can you hold if tech underperforms? Those questions matter more than a simple yes or no answer. For a long-term investor, the goal is not to own the most exciting ETF. The goal is to own a portfolio that can survive different market environments. QQQ may have a place in that portfolio, but it should have a clear job, not just a good story. Technology can be exciting. AI can be real. Growth companies can keep changing the world. And QQQ can still be a useful way to get exposure to those themes. But your portfolio still needs discipline. It needs valuation awareness. It needs risk control. It needs diversification. And it needs an allocation you can actually hold when the market stops rewarding the same winners. The future can be exciting, but your portfolio still has to survive the present. That is why boring investing does not mean avoiding growth. It means understanding what you own, sizing it properly, and not letting hype replace discipline. Boring money usually wins because boring money usually survives.